Okay, good afternoon, everybody. Today is September 10th. It's Friday. The market just closed. This is your weekly take on the market. I will be your host. My name is Scott St. Clair, Senior Product Coach here at MarketSmith. Here's the disclaimer. Any stocks that are mentioned are not buy or sell recommendations. Please do your own research. Take a moment to read that. Okay, so today wasn't a very good day. The market closed basically on the lows. It's not that far off of all-time highs. So it's you have to be careful getting too bearish too fast. But I just think the tape is very, very heavy. So I've got the market in yellow, the leaders in yellow. Some leaders have broken down actually, but there are some stocks acting fantastic. And then, depending on your portfolio, I am mostly on the sidelines. I have very little exposure. So it's hard for me to be green or red. It's hard for me to make much headway either way with the low exposure I have. Let's revisit this chart. So we're right into the teeth of seasonality. I got this chart from the book Alpha Trader by Brent Donnelly. And it's just an overlay of equity since 1990 every year, and you can see as a general seasonality, you top in September, mid-September, and bottom in early October. So September is historically the poorest month for the market. It's hard to think of why, but it doesn't matter. There's a lot of evidence that seasonality exists, so keep that in mind. But just because you have a coin that comes up heads 80% of the time doesn't mean it can't land tails, right? Because it's going to come up tails 20% of the time. So you'd never bet your whole bankroll on a coin flip, even if the coin was loaded at 80 or 90%, because you could go broke pretty easily. But I keep it, the seasonality and the fact that the market just feels like it's stuck in mud are two factors to consider. Let's go ahead and open up the markets. You should see a chart of the NASDAQ composite. And, we're barely off the highs. I don't know what the volume will be like today, but today felt like a distribution day. We'll have to wait and see what IBD says by the end of the day. But you're still above all the moving averages. It just seems like, again, the market is like stuck in the mud. It's just not making a lot of headway. You've got the relative strength, which I've talked about 100 times now. Maybe it's a tiny bit better finally, but took a lot of energy and price move to generate a tiny bit of relative strength for whatever it's worth. I wouldn't put a whole lot of weight in that. If you have stocks you like, keep them. I don't think I'd be on margin here. That's for sure. Well, I wouldn't be. I'm not on margin, but I don't know if you want to be running for the exits either, because you might push out a really good stock, and the good stocks are hard to come by. Here's the S&P. 4 days in a row. It's been a long time since we've had 4 down days in a row. It's very unusual. Actually, it might even be 5, barely, but it's very tiny bars. But I was at the gym with a friend yesterday, and he's like, "What's going on? The market's down 4 days in a row." Like, he just couldn't, it was like sort of tongue in cheek. He's not a trader; he's a teacher, but he noticed that the market was down 4 days in a row, which is unusual, right? He's just not used to seeing that kind of unbelievable weakness, right? So, I'm very neutral at best on the overall markets. IWM. Not a whole lot, just going sideways over and over and over. EEM, a lot like IWM, maybe even worse from a relative strength standpoint. Not a whole lot there. Let's go to the industry groups. Let's look at, haven't looked at ARK in a while, but here's the, the leading ETF. You can see it's tried to get above the moving averages a couple of times and it's really kind of struggling. So go to the weekly chart. It just doesn't look that good. The relative strength is very poor. Feels like it's being held up by the strength in the market. And this one is filled with, you know, the really big growthy stuff. So this is a good proxy for, you know, growth stocks. Let's look at IBD 50. Not doing too bad, right? Tried to break out this long base and it's giving back a little bit of the gains, but not too shabby. Actually holding up much better than ARK. Didn't make as big a move as ARK previously, but holding up pretty well. The industry groups. Coal is still number one. Finance consumer loans is 2 on the back of UPST. Retail department stores, probably Kohl's and Dick's Sporting Goods holding that group up. Semiconductor, fabless, computer tech services, computer software, steel. So the groups aren't that bad. At the top is not a lot of groups that interest me. Energy, coal, consumer loans besides UPST and retail department stores, probably not my favorite groups. But the groups aren't signaling any kind of huge change as far as, you know, defensive shift. Let's go to some stocks. Let's start with Affirm. What a rocket ship. Just crazy strength. You get the gap on the Amazon news. And then today you got the gap on earnings. I'm not in Affirm, unfortunately. It's really powerful move off the lows, but that's you know, something to watch as far as showing a new leadership. I love this group. Some of my best stocks: DLO, PayPal, Square. Even Adyen I owned for a while. It trades in the Netherlands, I believe. It's just a great group as far as growth and innovation. And so that's, you know, a good place to be fishing, so to speak. I don't know if this is the reason, but it seems like a culprit. But the strength in this group is hurting 2 of the hugest winners from the previous big bull run we've been in since 2009, and that's Visa. If you look at a monthly chart of Visa, it's not that much off the highs, but look at its relative strength way down here. The last time the relative strength was this low, Visa was 120. It's currently 220 and change. So it's the opposite of basketball underwater. The strength in the market is holding Visa up. So if the market gets weak, my first Visa and MasterCard, they will go. They're not going to be able to hold a bid because they're being held up by the strength in the market. Look at MasterCard. I can't remember if ever seen a relative strength of 29. So it might be a secular shift in the industry with Affirm and all this buy now, pay later. I know PayPal bought a Japanese company. I don't care. Above my pay grade. I want to have kind of an understanding of the industry and the way things are moving, but I'm pretty much a slave to the price. So if the price is going lower, I can kind of build a puzzle around the reasonings, and vice versa if the price is going higher. But these stocks look very, very tired, and they're big. They're components. You know, they're big components from the S&P and you know, on the S&P 500, not the Nasdaq. What other stocks was I going to do? You think I would have wrote those down, right? That would have been the smart thing to do. I can't remember what other stocks that I was going to do. Let me just go back to some of the new favorites. So Globe looks like it's finally going to take a rest. You have big volume breaking, closing right on the 50-day. This ideally, hopefully that becomes a base. That would be perfect. DLO holding up a little bit better, but you know, when it broke out of this, what I would call a nothing, it failed. Not surprising to me. I was a seller into that strength. One thing that Bill O'Neill said that really stuck out with me in one of the web seminars I went to, he says, if the stock's breaking out of a nothing, and I think he might have even said it on the home study course for the model book home study course, that's a sell. And if so, when people are getting excited, when I see a lot of Twitter chatter about a stock and it's breaking out of a nothing and I own it, it makes me highly nervous, and often I will reduce or exit the position into that type of strength. Uh, the hard part is I don't want to get, sometimes you don't want to get rid of all of it because it's so hard to get your money back. And it's not going to work every time. So if you really like the name, you might have to just grin and bear it in, even assuming it's going lower, but it doesn't mean you're going to be right. So far, yes, on this, you can see I actually have a trend line alert here. I really hope DLO breaks below the trend line, shakes the tree a little bit, and then I'll look to buy some strength on the way back up. It doesn't mean it's going to do that, but that's kind of on my wish list, which is why I have that trend line alert. I feel like there was one other stock I wanted to talk about. What we can talk about is uranium, just on fire, crazy strength coming out of this cup. I really felt like this was a double bottom. So to me, that was the buy point. So it's way, way extended from even this cup, but even the double bottom for sure, and needs to consolidate. But you can see last time it broke out of a base, went a long way. So I'm just going to try to survive any pullback here, but that's really unusual strength. I remember the stock I wanted to talk about that triggered it was CCJ. You can see it coming out of this cup. I think it's about 15 to 20% of the URNM ETF, and it's a piece of the URA ETF. But this stock's acted really strong, extended. See if it can hold the gains. Last time it couldn't quite hold the move, but the move last time sure wasn't as powerful as it is this time. Okay, so let's go to the quote of the week. And I have two because I couldn't decide. Jesse Livermore, trade only when the market is clearly bullish or bearish. That's the key word here for me, is clearly. I often have a position. I have a hard time stepping completely away, but what I do to combat that is there'll be very small positions, 5, 10% invested, 15, 20% invested, something like that, where it's not clear to me of the direction, which is where I stand right now. The market is very bullish, but it feels like it's running out of gas a little bit. And so it's not clear which way the direction is. So if I'm going to trade only when the market is clearly bullish or bearish, this is not one of those times. So I'm going to wait for a better opportunity. And if I'm wrong, I'm wrong. I just sit it out and wait. It'll come to you. I promise. There'll be a period where the markets are very strange in that it's not like a regular job, where you can punch a ticket and work 9 to 5. If you've ever tried to make your living from the markets, it's a much different mindset. So you might have a great January and then, starve February, March, April, and then have a fantastic May, and you put it all together and you're making a really good living on average, but you have to fight those urges where, I got to pay my bills this month. I better make some money. So I don't see the market as that clear in the direction. So maybe reduce your exposure if you feel the same. Aaron Brown, I think I used his quote 2 weeks ago. He is the former risk manager for AQR Capital. I love this quote. For risk managers, remember, he's not a portfolio manager. He's a risk manager. He's managing the book at AQR, looking for, potential bombs to go off, whether they have too much exposure in this sector or too much exposure, period, or they own too much of XYZ. At William O'Neill and Company, Bill was the risk manager in essence. If he saw that they owned too much Google or too much Apple, if all the portfolio managers who were acting independently center around one name, they would cut those guys off. It would be, it would move to a restricted list, so to speak. And you didn't have to sell what you already owned, but you couldn't buy any more. And so this is kind of the same thing. For risk managers, hedging is always a bad thing. If there's risk you don't want, then you get rid of it. I'm a big proponent of this. I've tried hedging before and it just never works. I just don't know when to get out of the hedge, or should I keep the hedge and allow it to run? let's say I'm long a bunch of stocks and I short the market, and then the market opens lower on Monday. What do? Do I take off the hedge? Did it serve its purpose? What happens if the market gets much worse by Monday and I've taken off my hedge? And now it's like, oh, I better put my hedge back on Monday afternoon for the close. And then Tuesday, the market opens higher. And now it's like, oh, what do I do with this hedge? So you just add so many flies in the ointment in your decision making. You make it very difficult. So I very rarely hedge. What I do is exactly what Aaron Brown says. You just get rid of it. So if I don't like the market and I'm 80% invested, then I go to 70%, 60%, 50%, 40%, whatever the number is. I just keep reducing until I feel like I'm positioned correctly. I don't have 80% long stocks and 80% short the S&P because sometimes in the last few days, or I've seen that with like MRVI announces a secondary, a stock gets hammered. What good would my hedge in S&P 500 be for a stock like that? It's worthless. S&P went up, MRVI went down. So what do? I reduce the exposure. I get out of that one, the one that's hurting me, rather than short more S&P to try to offset the stock that's hurting me, or if I own GLB or DLO, et cetera. So I'm not saying that hedging can't work, because in theory, it sounds great. And I really like the idea. And I've tried it a million times, but for whatever reason, it's never worked that well for me. So this quote resonates with me. If you find hedging is difficult, don't worry about it. Just reduce your exposure. There's no reason you can't go from 80 to 70 to 60 or 120 to 80 to 50 or whatever the numbers are. You can always ramp back up. If I go from 80 to 50 and it was bad, I can always go from 50 to 60 to 70 to 80. And nowadays, it's very easy to get your exposure back in there. Commissions are free. We're not going to go down the road of taxes. We've been there 100 times. Okay. Thank you, guys. That's going to do it. Here's our contact information. Reach us at marcussmith.com, 800-831-2525. Our social media, Marcus Smith, Zen in the Markets. I do get on Twitter a little bit, but I don't tweet actively, and mostly from a compliance standpoint. I'm a little bit wary on what I can tweet. So food for thought. Next week, Tuesday, my colleague Arnie and I will be doing a webinar on just using Marcus Smith. What are some simple strategies? For a lot of you, it'll be old hat. You're welcome to take the day off. You don't have to join. But if you're new, if you're on a trial or something like that with us, if you want a refresher on using Marcus Smith, then it could be a good thing to watch. It starts at 11:30 Pacific time on Tuesday, and they're all archived. So if you don't watch it and want to, you can always watch it on a recorded version. Have a great weekend. We'll be back next Friday. Bye-bye, everyone.